welcome everyone. Thank you for joining today's webinar, Economic and Market Update. I'm Jessica Ballin, one of the advisors on the 401k Plan Professionals team. If you're not familiar with our team, there's Jenna, Gina, Virginia. We're independent financial advisors, and we spend 100% of our time helping companies and their employees with their retirement plans. Today's webinar is part of our regular webinar series. The majority of our webinars are 30 minutes, including today's webinar, and I will be monitoring the chat. So feel free to chat your questions as I'm going through it, and we'll maybe ask some questions to Marta throughout the presentation. We're also going to allow time after as well. We have 18 webinars scheduled this year on a variety of topics. So we host an annual Social Security webinar. That was in March. We have Medicare, we have young investors, mature investors, a variety of topics, including health savings accounts. We actually book out our webinars 6 to 12 months in advance, so little did we know how timely today's webinar would be. All of our webinars are recorded, so you'll get the recorded link sent to you after today's webinar. Also, you can find all of our outstanding videos and webinars out on our website at 401kplanprofessionals.com. We have an on-demand education. We also know people like to get information through YouTube, so we have a YouTube channel as well. If you subscribe, you will get a message when there's new content out there. You can find us on YouTube at just 401kplanprofessionals.com. So with that, I'm super excited to have Marta Rodriguez. She is co-hosting today's webinar. She's a defined contribution expert at JPMorgan. She's actually, you might recognize her. She's co-hosted a number of our economic update webinars. She's spoken in person at our client events and everything that's happened in the last month. And really excited to hear Marta's insight and JPMorgan on what we expect the rest of the year. So with that, Marta, I will turn it over to you.
Great. Thank you so much, Jessica. And it's a pleasure to be here. I'm always so honored to be invited to be a part of your team and what all you present to your clients. Today, first of all, I just want to start off by congratulating you all on surviving the first quarter of 2026. Last year, we as investors contended with every flavor of risk. We had tariffs, we had wars, we had government shutdown and existential AI concerns. Fast forward, the start of this year is rivaling all of last year, condensed into one quarter. This year, war has led to soaring gas prices. I'm sure you felt that when you've gone and gassed up your cars. AI anxieties have bled into just some software, financials, and private credit concerns, so kind of upsetting the market. Also, we have a new Federal Reserve chair waiting in the wings, coming to come on board. And just tariff uncertainty remains as just because of the IEPA, that International Emergency Economic Powers Act Supreme Court ruling that we recently had. So despite all that, despite geopolitics being a top concern, the U.S. economy has been pretty resilient, although still shock sensitive. So consumers, so us, businesses continue to spend, supported by deficit spending and stimulus that the government provides. The economy, though, could face some oil and commodity shocks and some supply chain reshaping, which could impact inflation. So we'll talk about that a little bit, as well as higher rates than the market expect. So it's a lot to unpack, but I will try in the next 20 minutes to review a number of these economic and market topics, and then finish up with how we as long-term investors should be thinking about all this. So to start things off, let's take a look at oil. I think it's top of mind for a lot of us. The Iran war sent oil prices surging 58% in a single month, with the most immediate effects concentrated in those high energy importing countries. Now, we as the US, we are not an importer of oil. We are actually a net exporter. However, we are still feeling the high oil prices because it is a global commodity. You'll see here on this screen the retail gas prices in blue was 2022 when we saw the spikes happening. Right now in orange in 2026, you'll see that we're starting to spike back up close to the $4 national average. I'm based here in the Chicagoland area where we're feeling it north to kind of close to $5 per gallon. So it definitely is hurting. That being said, the U.S. administration is under increasing pressure to find an off-ramp to this war with Iran, just given the fact that we are running out of weapons, both offensive and defensive weapons, and just also the rising economic damage resulting from this conflict. If we expect, and we do, the conflict to end hopefully soon, then energy prices may still somewhat remain elevated for months to come, with some mixed implications for the US economy. Again, you'll see the oil shock here, but we do not believe that we will go into this oil shock will push the US into recession since, unlike previous years, we are now a net exporter of oil. However, with the rise in oil prices, it implies that we as domestic consumers are losing out because of the higher oil prices, whereas the domestic oil producers, companies like ConocoPhillips and ExxonMobil and Chevron, they're actually gaining and they look good. I mean, they're up 30-40% year to date. So on the when you look at the markets, whereas it has been volatile and the S&P is down somewhat for the beginning of the year, still there are sectors of the economy that are doing really well. However, what I want to show though on the bottom right of this chart that's entitled Consumer Expenditures on Energy is that with this rise in oil prices, it will lead to further income inequality because you'll notice that for the bottom 20% of folks, the low income and middle income, the expenditures on gas and other fuels makes up a good chunk of their income. So again, this could lead to furthering a very serious affordability problem, potentially hurting spending on other consumer basics. If we're spending more on gas, we're going to be spending less on restaurants or groceries, etc. And it will contribute to an overall negative public mood heading into the November election. So because of that, we do believe that this administration is going to try to find quickly a way to resolve this conflict. So I often get asked, hey, with this going on, how much will growth fall? How much will costs rise? But I think it's good to step back and look at the long-term economic growth. And we're going to see that here on the next page. Data released in the first quarter has shed significant light on the long-term outlook for the US economy, both in terms of we have demographic headwinds as well as technological tailwinds. So we have two competing forces here that affect the economic growth of the US. On the positive side, productivity in the non-farm business sector rose by 1.7% in 2025, following strong gains that we saw of 2.1 and 2.7% over the prior 2 years. So that's a very good thing. As we show on the right-hand side here of this page, output per worker has risen faster this decade than in either the 2000s or 2010s. So with technology, we're able to be more productive with less workers. So this productivity surge has been aided by companies that continue to increase their capital spending on intellectual property and R&D. And you'll see that on the bottom left-hand side of the chart, the blue line, showing that steady increase. And we do believe that that will continue in the coming years as companies race to take advantage of the AI revolution. On the negative side, so again, productivity increasing, which is good, leads to good economic growth. But on the negative side, on the upper left-hand corner of this chart, you will see that there's a sharp downshift in US immigration over the past year. That combined with an overall continuing aging and exiting of the workforce of the baby boomers suggests that the working age population is now shrinking. Given that we are starting from close to full employment, this suggests that essentially all the economic growth in the second half of the 2020s, so from now going forward, will have to come primarily from productivity. Because you'll notice at the, again, that upper left-hand chart there, prognostication is negative numbers from working age population growth going forward. So we'll see, we have productivity positive, job workers less, but we do believe that we will continue to have a long-term economic growth close to 2%, which isn't amazing, but it's not bad either. So if we can continue at 2% growth, that is a good thing. So we just looked at drivers of GDP growth, which are those underlying economic factors, productivity, labor force, that cause the overall size of the economy to increase. Now we're going to take a look at the components of GDP growth, which represent the expenditure categories. So consumption, investment, government, and net exports, these are the things that comprise economic output at a given time. Here on this page, we do expect economic growth to pick up this summer due to strong income tax refunds. Some of you may already have filed your taxes and have already received refunds. But that we do eventually see us falling back to closer to 2% GDP growth, but later on in the year. So we do expect a pickup in the middle of the year and the resumption of slower growth by the fourth quarter. This forecast is based on an expectation of, again, continued fiscal stimulus directed at us, the US consumers. The first dose of the stimulus will largely be received by us consumers in April and May. And as we do receive those strong income tax refunds, especially due to the fact of the One Big Beautiful Bill Act from last year that afforded a lot of just tax cuts that are helping us out. But we also then will have a second dose possibly received over the summer if Congress decides to enact these so-called tariff rebate checks that can put more money in our pockets. And whenever we get money in like refunds or rebate checks, we tend to spend it instead of save it. It's kind of like a sugar rush to the growth that we see in the economy because we will be spending it on a lot of different things. However, we don't think that this fiscal stimulus of the government providing us more money in the economy will continue into next year, because if in November, if Democrats win a majority in the House of Representatives, they would be unlikely to support further unfunded tax cuts or spending increases that could give a political advantage to the Republicans. So consequently, we think that fiscal stimulus will wind down or even turn negative in 2027, restraining overall economic growth despite a continued AI capital spending boom that we're seeing by a number of the large companies out there. So that's a look at GDP growth. Turning back to labor real quick, I think it's worth spending a little bit of time on this page. Here you'll see recent trends show job growth is increasingly driven by, we're seeing healthcare and manufacturing professional services are experiencing declines. But overall, if you take a look at the left-hand side here, you'll see the non-farm payroll gains are going down. Payroll job growth has slowed significantly, transitioning from strong post-pandemic gains that we saw in 2021 and 2022 to a much more cooling market now in 25 and 26. Despite continued economic growth, we expect job gains to be somewhat lethargic in the year ahead, with roughly 50,000 payroll jobs added per month. This reflects both a lack of available workers due to changes in immigration policies, as well as though we do solid gains in productivity. Because again, if productivity gains are increasing because less workers can do more and provide the same amount of output with higher productivity, that means employers don't need to be hiring as many people. However, though, this lack of labor supply means that the unemployment rate, and you'll see that on the far right-hand side, currently the gray shows that as of February 2026, our unemployment rate number is 4.4%. Historically, the 30-year average is at 5.5, but we're currently at 4.4. We do think, though, that that number could actually fall to end the year closer to 4% because of that lack of labor supply that I just mentioned. Interestingly enough, just a factoid that I read that I thought was interesting, that unfortunately, and a lot of the recent college graduates, so those that are aged 22 to 27, they're having a lot tougher time right now in the market finding job, and their actual unemployment rate is closer to 5.7, which is a bit shocking. I think that's definitely temporary, but that is a little bit hard to hear, especially as I have my oldest son going off to college and thinking about future prospects for jobs. But while the labor market is strong, as evidenced here by falling payroll gains here, it is tight, right? So in addition to tight labor market and a high inflation in the first half of this year, we only expect, though, a modest wage growth. So wage gains, as you'll evidenced here in the blue, we're currently at 3.7% wage growth, because I feel that a lot of companies are going to be very hesitant to raise wages in an uncertain environment. So because of that, if the wages aren't going to be going up as high, that will not be impacting inflation as much, something that the Federal Reserve looks at closely when deciding whether or not to raise or lower rates. Speaking of inflation, let's take a deeper look at that. This is one of our more colorful slides. I also think it's kind of reminds you of Stegosaurus, a dinosaur. You'll see in the middle of the page, a hump there. This, is an ugly reminder to us. Not that long ago, in June of 2022, we were hitting a 9.1% inflation rate. That was really, we felt that when we went shopping. But we've seen over the years that inflation rate has been coming down. Now, on this slide, the latest reading I have is as of February 2026, where it's at 2.4%. But a lot has happened in the month of March. Hence, we were talking about the oil prices spiking up. So energy, the energy component in green, we're going to see that start to spike up as well. As a reminder, what is the CPI inflation? The Consumer Price Index measures the average change over time in prices paid by us as consumers for a representative basket of goods and services. And we break that down to categories of energy, food, shelter, auto insurance, etc. We do think that over the next few months that we are going to hit 3.5% inflation rate, a big portion of that being the energy component part of it. Reflecting just the rising energy and raw materials from that Iran conflict, also tariff effects and on imported goods. We think that'll be add also to that inflation rate number. However, we do believe that inflation should fade quickly in the second half of the year, dragged down by a slightly lower level of tariffs after the IEEPA tariffs ruling, and also steadily falling housing inflation. We're starting to see that come down as well, reflecting overall slower rent growth, which in turn reflects weaker immigration. So again, we do believe that going into 2027, year over year, CPI inflation could well fall even below 2% as these trends continue, and comparisons with this year's energy prices become a lot easier. Now, central banks, so our Federal Reserve, uses CPI to determine interest rates and monetary policy. And right now, the Fed's kind of stuck trying to figure out what to do, right? The markets thought, hey, coming into this year, that we were going to be continuing some of the Fed rate cuts that we saw that started last year. However, they're struggling with the fact that, so the Fed, they have two main goals. They're looking to maximize employment as well as keep stable prices in the economy. If there are issues on the employment side, again, the labor force weakening, one would think that the Federal Reserve wants to stimulate things. But on the other end of it, their other goal of that stable prices we're starting to see that that inflation number is starting to tick up, which would mean that the Fed should be a little bit more restrictive. So they're kind of stuck in a rock and a hard place here. And as of early April 26th, the Federal Reserve has maintained, they're continuing to maintain that federal funds rate at a target range of 3.5 to 3.75%. And you'll see that that's the gray dot here on the far right of this chart, the federal funds rate. The markets were originally coming into this year pricing in two Fed Reserve rate cuts in 2026. However, 3 months into the year here, both of those projected rate cuts have been kind of disappear, and we haven't seen those. And we do think, though, that the markets are probably pricing in more hawkish Fed than the data will eventually justify. We don't currently expect any rate cut before December of this year. But if both inflation and economic growth were to slip below 2% by the end of the year, we could get a rate cut at the last meeting of this year and few more in 2027. But I don't envy the Federal Reserve's job at all right now because they're very much data dependent, but there's a lot of just data that's coming at them that they're trying to figure out, is this temporary inflation or will be stickier? And a lot of it's also dependent on continued data that they're bringing in from the working labor force. So how does all this, so the GDP growth, again, trudging along, we're thinking close to 2%, but possible spikes in inflation in the middle of the year before settling down, slower job wage growth. How does all this affect investing in this climate? So we're going to switch gears and look more than at both fixed income and equity and international and how we should be thinking about this as long-term investors. First, when we look at fixed income, I don't know if you remember, but a few years back, fixed income was paying you hardly anything, right? With rates that were really, really low. And so if we were looking to achieve good retirement outcomes, we had to shift into more equities to be able to get any sort of returns. However, over the last few years, you'll see that the rates that fixed income now provides are definitely meaningful. Here you'll see in the black, it says as of 3/31/2026, you have a current yields for your your Bloomberg US Ag Index of 4.57%, which is really quite good. Especially if fixed income still is going to serve as a ballast for your portfolios and it actually is paying a good, decent income, it's good to have that still as a diversified part of your portfolio. What this chart is showing you with the colors is that essentially over time, whatever your current yield is, that also implies a forward 5-year return of that same amount. So if our current yield is 4.57%, that does imply a forward 5-year return of 4.6%, which again, it's good. So we do believe that even though inflation phase, where I think later in 2026, these yields and potential returns seem very reasonable, and fixed income should be a decent part of your overall portfolio mix. Shifting to equities, I get asked all the time, hey, are stocks too expensive? Especially a lot of the concentration of the S&P 500 with a lot of those large cap mega names that has caused concerns. And we have seen that over time, valuations have been increasing. So one of the valuation measures is PE, so price to equity. So price being what the markets are willing to pay for what the companies are able to produce in terms of earnings. 30-year average for PE for the S&P 500 is around 7.2 times, or 17.2 times earnings. You'll see that towards the beginning of this year, we were north of 23, kind of 23 times, so very much overvalued. But there has been a correction so far this year, as you've seen in some of the negative returns year to date in the stock market, which has brought down valuations. Currently, as of the end of March, we're at 19.7 times. So it is something that we're coming a little bit closer to that 30-year average. But we do believe that this anomaly is persisting where the top, that concentration in the S&P 500, where the top 10 companies in the S&P 500 represent close to 40% of the market value of the entire index, meaning the other 490 companies in the S&P 500 make up the rest of that 60% value of the entire index. So it's very much concentrated. However, unlike last year, earnings have been spreading out, and a lot more of the earnings by those 490 companies have been increasing. And so we find that there's more opportunities by active portfolio managers to look at different sectors beyond technology where there are companies that are doing well in this environment. And essentially, actually, a number of those Mag 7 names that really pulled the market the last few years are actually negative so far year to date. So, that being in line of just some AI fears of maybe spending more and not really seeing the earnings being fully realized. So, because of this, yes, equities are still somewhat expensive if you look at pure valuations versus the rest of the market versus history. However, um, diversification is going to be key for long-term retirement success, and you do need to be in equities. But the beautiful thing is that there's a whole range of what to invest in underneath the hood. And we are starting to see that a lot more companies outside of those top 7, 10 names that have previously driven the returns over the last 2 or 3 years, we're going to be seeing that a lot of these other companies will be taking up the bag and producing solid numbers that will continue to have the S&P 500 continue to march forward. So domestic equity is still a great place to be, but I would not shy away from international. International was where it was at last year. I mean, I would say for the last 15 years, I think I've been talking about we have to go international for a diversified portfolio, but it's really been a hard story to tell when international has been hit hard for many, many years. But last year, take a look at the middle of this page in the 2025. US returned last year 17.9%. This is the S&P 500 returns. Versus if you look at Japan, China, EM standing for emerging markets, and Eurozone, you saw 20, 30, and 40% returns last year. So outsized returns. Now, this year, so the far right side of this chart, you'll see that year to date, the US were down negative 0.4, 0.3%. But there are, yes, Eurozone and emerging markets, Eurozone's also down, but not as much. And emerging markets actually and Japan are right there in line or even positive. But I do get asked the question, hey, was 2025 more of a flash in the pan and it was what it is, or should we continue to be diversified in international stocks? And we think you should for 3 reasons. One, even after a 2025 rally, non-US stocks still carry much lower valuations than their US counterparts. So it's still on sale, right? So if you're going to go out shopping and you're looking for a good sale, international is still is where it's at. Second, the dollar remains very much overvalued given our trade fundamentals, and we expect it to fall in the years to come. And when the dollar falls versus other currencies, you as US investors, when you look at international returns and that gets translated back to the US dollar, that falling US dollar actually increases the impact of those international returns. So that's a good thing. And then third, given just the outperformance of US stocks over the last decade, we do feel that like a lot of US investors are likely very underweight international stocks, and they will be starting to allocate money into the international, which that in and of itself should continue to boost relative international returns. So for those 3 reasons, we do still think that international has got a long way to go to run, and it should be a part of a prudent diversified portfolio that you all should be investing in. And just finishing real quickly with my last three favorite charts, I think, just again emphasizing the importance of being diversified investors for the long term, because over time you can't know year to year what asset class is going to do well. And for many years, large cap growth was where it was at. However, if you'll notice on this quilt chart on this page, year to date column, the far right, what's at the very bottom is large cap in green at negative 4.3. When looking back all the way 15 years, that's never been at the bottom. Historically, it's been towards the top, or at least the top half. However, again, year to year, stuff changes. But what is the best, I think, way to invest for the long term is by having a properly diversified portfolio, which is that gray asset allocation box that kind of goes across the middle. It's never at the top, but it's never at the bottom, right? So you get more consistent returns with less volatility versus trying to just game the system, figure out what sector is going to do well this year. That, along with, I like this slide, we call it our measles chart, but just to acknowledge the fact that, again, as long-term investors, we shouldn't get freaked out when we see this volatility in the markets, because every single year, and this chart goes back 46 years, those red dots show that every year, that's the intra-year drop that you've experienced in the markets. And in some years, it's been negative 30, negative 40%, right? On average, there's every year the intra-rate drop is around 14%. But out of 46 years, 35 of those 46 years have been resulted in positive numbers. So again, if we're thinking long-term investing, and I'm not a gambling person, but if I was, those are good odds of why it's important not to try to time the market, but to stay in the market in a diversified portfolio to be able to achieve the returns we need for the secure retirements we're looking for. And last chart, and then I'll open it up to any questions here. But this last chart shows time diversification and the volatility of returns. And here you'll see that for stocks in green, or bonds that in blue, in the near term, so 1 year numbers, stocks you can see varies, big returns of can be as north of 52% or could be negative 37. Huge volatility, right? But when you pan out to 5 year, 10 year, and 15 year, 20 year rolling, you're going to be positive, and especially with that 60-40 mix, so 60% equity, 40% fixed income, you're going to have a much more consistent path to solid returns over time. So again, not trying to time the markets, being invested in the markets, being diversified, we're all going to be good.
Yeah.
So with that, I'm going to turn it
Okay.
back to Jessica to see if there's any questions.
Thank you. Such good insight. Thank you. And just as a reminder too, of we preach the diversification. Those participants that are in those target date funds had a phenomenal year. Those, because you have that allocation international, you don't have to think about it. So it's a good reassurance that we're all fine, right? The diversification is common. It's not uncommon. So I'm going to close out the webinar quickly, and then I will go through a couple questions that we've had. Like we said in the beginning, today's webinar will be recorded. You'll be sent the link following the webinar today, and then it'll also be landing out on our website, 401kplanprofessionals.com. It's under the on-demand education, also on our YouTube channel as well. We also have out on our website our 8 Steps to Becoming Financially Well series. So if you want more information on any one of these 8 steps or all 8 steps, they're all about 4 to 5 minute videos. And you can also email us and we can send you we have an 8 steps worksheet that goes along with that as well. And kind of looking through the rest of the webinars for the year, you'll see we have, we'll go one more, yeah. Oh, wait, we'll go back to we have regular office hours. So if you ever need a one-on-one meeting, you can send us an email after this meeting, but we also have on-demand office hours. So anytime you want a one-on-one meeting, you can go to our website, 401kplanprofessionals.com/office hours, and you'll see our regular open office hours available for one-on-one meetings. And then closing out, if you wanted to see the 2026 webinars that have hosted and will host. Some of these are more for plan sponsors, and some of them are more participant driven. I think if you go to the next slide, you'll see these are the participant webinars upcoming. So retirement by generations. Our next one is Gen X. If you are a baby boomer, we did that in February. You can listen to that recording. HSA investing is a super popular topic we talk about. We'll have another market update webinar, Marta and I, in August. And of course, one of our most popular webinars is Medicare. And then if you're a plan sponsor, an HR director, and you're thinking, what's coming up for me for webinars? We have the number of webinars as well. I think there, and that's on the next slide. Yeah, so, and then we always have our regular fiduciary training as well. So with that, Marta, I think we can go to the next slide and then a couple questions. Just, I think, a lot of different investment companies throw around that R word, recession. So somebody chatted about, can you speak to a mild recession with the rate cuts that can boost the economy versus a more serious recession? Like, I kind of think of a mild recession and more of a correction. What is JPMorgan saying about kind of those possibilities?
Yeah, well, also depends on who you talk to at JP Morgan. We have some of our market insight teams that are very positive, and more optimistic, and some folks who are a little bit more not so much. But in general, what we're seeing is yes, it will be a little bit tricky here as we are still in the midst of. I mean, every time I open the news nowadays, just the continued conflict that we're seeing there in Iran, and China's just kind of waiting in the wings, just chomping at the bit, like figuring out what they want to do as well. It is impacting not only gas prices, right? But also I read recently too that helium, which one doesn't think of very much, but that's used a lot in AI chip software that also come from the Persian Gulf there. That's being cut off as well. So rise in prices of these ingredients that goes into a lot of things that we use will be going up as well. So that could, again, if this doesn't get resolved soon and surely, it could have a longer impact on
Mm-hmm.
the cost of inputs for a lot of things and cost of goods that we experience. And
Yeah,
that
the
could
trickle down.
lead to a little
Right.
bit more of a recession. However, I mean, I think our administration is really feeling the pinch. And, they're
Yeah.
also thinking about, hey, November elections are coming up. We can't have this negative sentiment that people are feeling, right? And so because of that, I think they're really trying to find an exit off ramp real soon. And if that happens, I think this will be much more of a temporary inflation. Again, we think it's going to hit 3.5. Is that currently close to 2.4? We think it could go up to 3.5 or maybe even 4, but it will then start to go down towards the end of the year. So we don't think we're going to hit recession territory. Again, we're coming from a stronger point of view. Consumers are still spending, businesses are still spending.
Mm-hmm.
We're more productive, but it is still a lingering concern, and it's really, I think, dependent on day to day what's going on, what's happening. So
Well, and I think if you go back to that one slide about an intra-year 14%, maybe 20% decline inside a year is not that uncommon too. So,
it's
some sort of
not. And so far,
volatility
with
we
all
experience.
that, yeah, that being the case, Jessica, with all that's going on, we're only down -7 or something.
Yeah,
And that's
right.
not for all that's been going. So again, and if on average it's -14, I think again we're
Yeah,
not gonna. I think we'll be fine.
yeah.
We're not gonna hit that recession territory, but it is still concerning. And we as
Right.
investors, we see all this, and it makes us nervous.
Mm-hmm.
But again, we know that unless we need to pull the money out this year, right? If we're
Right.
10, 15 years out, this is gonna be
Mm-hmm.
a blip. We're gonna be fine in those diversified
Yeah.
portfolios. So.
One question was on international. So somebody kind of chatted about percentage of international they should have, which I can clearly answer that one. Is 25% appropriate? We always say kind of 15 to 25%. Those target date funds, if you're 30 plus years from retirement, they'll likely have 20+% in. It's also a
Mhm.
comfort level as well. But having some international, like just like Marta said, we've been preaching. I mean, I've been allocating and preaching for 15 plus years. I was very happy last year that it actually paid
Played
off.
out.
Yeah, and precious metals was another question. We all talked about gold was like, I mean, the amount of questions we got about gold and precious metals last year, because
Yes.
gold's up. So, what type of allocation do you see in that type of portfolio? I mean, that's more of a commodity that would be very, very volatile. So
Yep.
we would put that more in. You might see some sort of allocation in some target date funds, right, Marta? Would you say that
Mhm.
JP Morgan maybe allocates a slight portion in some sort of commodities, precious metals, and those type of categories
So,
in there?
yeah, within our targeted funds, and not we don't have a commodity exposure as much, but we do are invested in real estate, right? So
Mm,
that's something that we're invested in. Commodities, I think I see that a lot more of our wealth folks on the individual wealth side tend to have an allocation there. But we do feel like a lot of that the inflation benefits that that provides to you is met by a lot of some more fixed income allocations as well. So,
right.
but I mean, it is something that, yeah, gold. I mean, people were like, let's rush to that in light of all that was going on.
Right.
And also why I don't think that, there's also talk of, well, is our US dollar, will that ever not be that reserve, right? But it will forever because I mean, it's even though it's still somewhat overvalued. It still is a mean of safety, right? With all that's going on, people are putting money in the
Hmm.
US dollar, in gold, and in commodities. But it is a much more volatile, especially a lot of those commodities are tied to what's going on in the geopolitical landscape as well. So yes, they can provide diversification over time and provide additional returns, but you understand that it does provide additional volatility too.
Hmm. Yeah. And just to kind of close it out, this is why we're here, right? So we're advisors. We're here to help you. We can look at your allocation. We can help go through those and give you advice. So you can always reach out to myself. There are my emails up there, any one of our team members, and we can help you review your portfolio. So with that, thank you so much, Marta. This was very insightful. We'll see you again in August, and let
Okay.
us know, everyone, if you have any questions. Thank you for joining.
Thank you so much. Have a good
Thank you.
one.